Welcome back to Make Finance Easy. Today's video is going to be on understanding exchange rates and foreign exchange market. Today, I'm going to explain exchange rates and how they affect international trade. I'll cover four main ideas: what exchange rates are, how the foreign exchange market works, how government policies and economic conditions affect exchange rates, and finally, how exchange rates influence net exports. First, let's define exchange rates. An exchange rate is the price of one country's currency in another terms of another country's currency. For example, if one US dollar can be exchanged for 150 Japanese yen, the exchange rate is 150 yen per dollar. Exchange rates are important because they determine how expensive or cheap goods from different countries are when people trade internationally. Exchange rates can change over time. When a country increases in value compared to another country, we say it appreciates. For example, if the US dollar strengthens and can buy more euros than before, the dollar has appreciated. On the other hand, when a currency loses value and buys less foreign currency, it depreciates. Next is the foreign exchange market, also known as the forex market. This is the global marketplace where currencies are bought and sold. Just like other markets, prices in this market are determined by supply and demand. Demand for a currency comes from the foreigners who want to buy that country's goods, services, or financial assets. An example is if people from Europe want to buy American technology, or if they want to invest in US companies, they need US dollars. This increases demand for dollars, which can cause the value of the dollar to appreciate. Supply of a currency comes from domestic consumers and firms who want to buy foreign goods, services, or investments. For example, if Americans buy more product from other countries, they supply the dollars to the foreign exchange market in order to get foreign currency. Economic policies and conditions can also affect the exchange rates. One main important factor to consider is interest rates. If a country raises its interest rates, investors from other countries may want to invest there to earn higher returns. To do this, they must buy the other country's currency, which increases demand and causes the currency to appreciate in value. Another factor is inflation. If a country has a higher inflation than other countries, its goods become relatively more expensive. As a result of this, foreigners may buy fewer of those goods, which reduces demand for that country's currencies and can lead to depreciation. And finally, exchange rates only affect net exports, which is the value of the exports minus the imports. If a currency appreciates, domestic goods start becoming more expensive for foreigners. So exports decrease and imports increase, reducing net exports. If a currency depreciates, domestic goods become cheaper for foreigners and exports increase while imports decrease, which increases net exports. This shows how exchange rates play an important role in international trade. And that's all for today's video on exchange rates and understanding the foreign exchange market. And I'll see you guys later.